Good afternoon, everyone, and welcome to today's webinar, the 2025 Real Estate Outlook, Market Trends, Policy Shifts, and Investment Opportunities. I am the host. My name is Deanna, and I do investor relations for Tempo. I wanted to thank everybody for coming on today. We have a big panelist group here, and I'm excited to have all of your niches being represented across the entire commercial real estate industry, but also we have a few people who are not commercial real estate related. They do macroeconomic and worldwide investing. So it'll be a really interesting conversation. So before we dive in, I just wanted to have you all submit any questions that you have along the way into the Q&A, and we'll get to them as we go through. We'll open up, the end for live questions as well. But we do have a couple of topics that we're going to go through. First, I'm going to have each of our panelists briefly introduce themselves for about 2 to 3 minutes, just your name, your company, your role, and what you're most focused on right now in the market. And anything you feel like would be good context to share. So I will start with Scott Myers. Scott, thanks for being here today.
Thanks, Deanna. Thanks, Mike. Welcome, everyone. Always good to be here to chat about what's going on in the market, especially in the niche that we find ourselves in as well. Again, my name is Scott Myers. Company is Kingdom Storage. We have a number of other affiliated companies, but that is the main holding company for what we do. Background, well, it started out, I think like many people when they begin in real estate with single family houses, a lot of rentals, some flips, then we got into multifamily, office buildings, warehouses, parking lots. And then, well, self-storage found me. I can't even say that I found it. It's that at the time back in '05 when I got in, it was the stepchild of the commercial real estate industry, these metal boxes on concrete slabs that I thought was well, just that, this stepchild of commercial real estate, until I began to look at the numbers and dig into the business a little bit more. And then after we bought our first facility, we saw the light, and we sold off all of our other holdings and just went full bore into self-storage. And so that is all we do right now. That is all we own, which is self-storage, with the exception of one single family rental house. And I take that back too, the one we live in, and an Airbnb. And that's it. That's all we build from the ground up. We've done developments. We do a lot of conversions, which has been really probably our bread and butter and our sweet spot, not only in this last economic cycle, but also just because it makes more sense to buy a shell and then convert it. It's quicker to market, save a little bit of time, a little bit of money, but also in acquisition mode. We just closed out a $25 million, just a small $25 million acquisition fund as well, where we are still actively buying. So we cover all the food groups within self-storage with acquisition, conversion, and development. Relevant highlights. Well, I don't know. I've been in real estate for 32 years, and I guess I'm still standing. That's the background and the context you asked for, Deanna. That's I guess the main thing. We've been at this for quite a while. We've been through a number of recessions, but I think any of the panelists will probably state here as well. And Mike and I have had a lot of conversations about this. Those of us that are here on the panel, folks, you dialed in for a reason, and that is because there is some wisdom here. And not speaking for myself, but when you go through some recessions like all of us have here, I've been through 3. You just get a little more perspective. We see a little further down the road. And so I'm always thankful to be here and to have those conversations because that is what many people are looking for. If you're heading into the first economic cycle in which you're facing that, it's going to look dramatically different the next time you go around, having gone through one. So lean into everything that this panel has to offer today with regards to that, the wisdom and the context from the past recessions, and being in the trenches and the bumps and the bruises and the scar tissue that we all have. So thanks again, Deanna. I'm looking forward to this.
Thanks, Scott. Thanks for joining us today. All the way from Dubai. That's it's 8 o'clock over there. Just want to point that out. Thanks for joining and making time.
My pleasure.
Erwin, thanks for coming on today. You're muted, Erwin.
There we go. Erwin Boris, Heritage Capital. We are a third generation family-run real estate business. A little bit about me. Started as a practicing CPA. After 4 years, wasn't cut out for me, numbers and boxes. That's before everything was computerized. Went to work for a large owner-operator who's on the Forbes list, taught me the management side of the business. Just loved going to landlord-tenant court and figuring out all the games tenants can play. So over the last 40 years, I've spent probably half of that working as a lender, doing debt and equity originations and closings, and the other half working for owner operators building platforms from multifamily, multi-asset into now small bay flex and industrial. I've heard all the stories, the good, the bad, the ugly, the games sellers play, buyers play, and even some lenders will twist you around with. Um, right now, we are focused on multi-tenant industrial shallow bay flex. We are in the market selling our remaining multifamily asset, tired of the fluctuating operating expenses, the gross nature of the leases, and inability to control things like insurance with the natural disasters and how multifamily insurance can triple in a year or two or three. And we are actively out there acquiring these multi-tenant industrial properties for their cash flow, because really it's the only thing when you close, and it's a question of how do you keep growing those rents over a prolonged period of time and adding value for your investors. I guess today's market is kind of interesting. I don't know whether people are playing games with the stock market or what's going on. Some people might say, well, if you're driving down the stock market, you really want to refinance the country's debt, but that's not happening because treasuries are going up. They're not going down. There's no flight to quality. I think we're really in uncharted territory, and I think investors really should be focused on cash flow rather than anything that's pro forma. Because man makes plans and God laughs, and I like boring investments. I like to sleep at night. We don't use a lot of leverage, and I really think that for the next 2 or 3 years, you really got to be careful in what you invest in.
Yeah, thanks. I like boring investments too. Dave, thanks for joining us. I'm happy you got to join us this time.
Dave Van Horn, co-founder and board member of PPR Capital Management. We are a private equity investment firm. Our primarily investing in distressed assets, mostly residential mortgages nationwide. We also do some commercial real estate investing as well in a half a dozen plus states. We do like multifamily, workforce housing, affordable housing, and build to rent as well. And then we have a minority interest in an opportunity fund in the car wash space as well. So we do a little bit of variety there. I've been in real estate pretty long too, coming up on 40 years. I started back in like 86, acquiring properties and investing. And so, long time at this game, raising capital, deploying it, similar to other folks on this call. So thanks for having me.
Well, I'm excited to have you. Thank you. I'm gonna call on Ryan next.
Thanks, Deanna. Thanks, Mike. Hi, everyone. I'm Ryan Severino. I'm the chief economist and head of research at BGO. If you're not familiar with BGO, BGO is an institutional private equity real estate shop. We have somewhere between, let's call it 80 and 90 billion assets under management, with really like a very broad footprint, almost every property type. I won't say every place in the world, but as a global firm, we'll go most places in the world, and really across the risk reward spectrum, everything from debt funds to value add, even leaning more toward the optimistic side of the ledger. As far as myself, I never mind dating myself. I've been in the real estate business almost 30 years, and the way I explain it to people is in increasingly nerdier positions. More economic theory, more mathematics, more computer coding across multiple languages, not just in terms of pure sort of economics and econometrics, but even now with the stuff that we're doing in terms of really pushing the envelope for artificial intelligence and machine learning. And I've been around the block enough that I've seen this business from multiple angles. I've spent about a third of my career on this side, on kind of the GP investor side. Spent about a third of my career on the sell side services side at JLL. And then I spent about a third of my career on kind of the data and econometric side. So I've gotten a very interesting perspective on on the industry over my time. The last thing I'll say is, to your question about what I'm focused on or what's occupying my attention. I'll apologize to everyone, as I mentioned to some before. I have to drop after about an hour. And I would say trade policy and everything that the world is concerned with right now. I would say I have been inundated with emails and phone calls that I'm trying to get finished before I depart for vacation tomorrow. So that is easily the thing that is occupying most of my time right now. But thanks again for having me. I'm looking forward to the conversation.
Well, thanks, Ryan. Yeah. Really excited to have you as well with your background. Mike, actually, I'll have you introduce yourself next.
Thank
Mike,
you, Diana.
yeah.
First of all, I am really honored and grateful to all of you for joining us for this event, and also wanted to thank all the folks who are tuning in. And I'll just have two quick comments. What's the most productive day of the year? It's the day before vacation. So Ryan, I'm sure today is an incredibly productive day. Most folks do that. So Mike Zlatnik, call me Big Mike. Yes, I'm 6'4", big guy, and the name stuck, and the cheesy podcast name, Big Mike Fund Podcast. So from Moldova with love, not to be confused with the James Bond movie From Russia with Love. So I come from small republic of the former Soviet Union, Moldova, in '89, lived in the United States since then, U.S. citizen, U.S. patriot, real estate investor since 2000, and run Tampa family of funds and syndications. And today we're focused on deep value buys. As the market shifted, we all acknowledge this. What we do see today is a tremendous reset that took place, and the new opportunities to invest are phenomenal on a historic basis, based on many metrics, such as reconstruction cost, such as spread between cap rate and the interest rate, such as essentially acquisition relative to what it was at the peak of the market. Right, so we look at all these metrics, and we're seeing today is a great time to put fresh capital to work, because uncertainty, like Warren Buffett says, when there's blood in the streets, that's the time to invest. So that's what we're looking for. We also obviously in this environment looking for recovery capital, mezz debt, some folks call it pref equity. There's all kinds of interesting opportunity in that space, and still great time to be a lender. So I will shut up again. Dave Van Horn does a lot of notes, and if you can be a lender at a low risk, good reward type of environment, that still seems to be a good opportunity. But deeper buy today is on the equity side if you can get it right. So that's my 2 cents.
Well, thanks, Mike. Andrew Gee, thanks for joining us today.
Thanks, Deanna. Mike, thanks for inviting me back, and I'm happy to be here. Andrew G, co-founder of MAG Capital Partners. I've been in the real estate industry for over 20 years. Started as a consultant and did brokerage, eventually to investing, and now fund manager. Over kind of the years, we've invested in really kind of most commercial real estate assets these days, and really kind of for the past almost 10 years, the primary focus has been industrial, specifically single tenant net lease. So we invest in all throughout domestic US, looking at opportunities and looking at real estate, but also from a credit perspective, as we're looking at single tenant assets. We also do some multi-tenant, small bay industrial investments too. And so, yeah, it's very interesting times right now. And, I think I like to listen more than speak, and want to just kind of soak in wisdom. So looking forward to what everyone has to say. I have my personal opinions too. And so I think the more, heads we put together, and this, at least just understanding different perspectives is always helpful.
Yeah, well, I'm excited to have you here as well, because there's always, well, lately especially, there's a lot of talk about industrial. So excited to hear your input. Thanks for joining us. And Heath, I wanted to have you go next to introduce yourself.
Sure. Thanks, Deanna.
My name's Heath Binder with LBX Investments. We're owner-operators of retail and multifamily. Portfolio of about 800 million in value under management. We're nationwide owner-operators. We're actually working on a deal right now in California, but we own up in the Northeast and the Southeast, Midwest. In our company. So what I do is I run investor relations and capital raising for the firm. We're value guys, and we're a little bit contrarian because we've been investing in retail for a long time, but we look for very well located assets that we can acquire at a really good price point, and then actively manage to generate alpha. Thanks for having me today. Looking forward to hearing what people have to say about the current climate that we're in. It's an interesting one.
Yeah. Thanks for joining us, Heath. Looking forward to hearing your input, especially. The other person who actually is going to have a really good outlook on and a global perspective is Alastair. And we had Alastair on our Lunch and Learn series last month, but I'm excited to have him on again. He's always a great conversation. So thanks for joining us, Alastair.
Happy to be back, Deanna. Thanks for having me. Thanks, Mike. Pleasure to meet everyone else here. I'm originally from Zimbabwe in Africa. I grew up at the tail end of the global economic whip. For every 10-mile-an-hour move in the handle here in America, our economy was effectively breaking the speed of sound. So I grew up burdened by tariffs, 80 to 132% tariffs for my first business, is the story of my life. Over the course of my years in business, I've lived through 5 recessions, the greatest hyperinflation in history, and the greatest asset deflation in history. So cycles are my specific focus of expertise and interest. Cycles that play out at multiple degrees of scale inside of every market that we're touching on. Wherever there's an auction system at play, there is a cycle. My work right now, outside of my own individual businesses, I own a suite of dental practices, not a dentist. Previously, I built and sold veterinary hospitals. And prior to that, I built and ran an investment fund that I navigated through the financial crisis extremely profitably, that I sold in 2015. Bulk of my work today and my focus is with clients that are either individual investors or entrepreneurs. I also have a small group of private clients that have significant businesses in different industries, allowing me to kind of cross-pollinate my own inputs and thoughts, both with those clients in my mastermind and those individual clients. I've also advised state governors on strategy and, as we know, in politics, specifically messaging about that strategy. So this is an interesting environment. Clearly, the next half cycle is upon us. And it's a very exciting time. I have so many experiences to fall back on. I'm actually quite excited about what lies ahead, but happy to be here.
Yeah, I guess it's a different way to look at a cycle when you have some experience. Definitely not a crisis, more of an opportunity.
Well, that's the point that you make there, Diana, is a great one. The truth is, if you've only been in business for 16 years or less, you're a half cycle entrepreneur. If you've only been in business for less than 45 years, you're a half cycle interest rate entrepreneur and business owner. We are inside of multiple cycles rolling over at huge degree of scale. And so we're going to get our models tested, that's for sure.
Well, thank you. I love how you share a lot of data. And I thought about how much data Neil Bawa shares whenever I was thinking about who to have on this panelist discussion. So thanks for joining us, Alastair, and I'm excited to have you as well, Neil. You're a first-time guest, so welcome.
Well, thanks for having me. I'm listening to all these folks. I've heard Alastair before. I I hesitate to say that this is just an opportunity. I think that we are in the middle of an extraordinary reset that, in my opinion, will create dramatically different outcomes over the next 5 years than it did in the last 5 years. So I did not consider COVID to be a reset. I did not consider 2008 to be a reset. But what just happened is the most extraordinary reset that we've ever seen. And I think that it has both very good consequences for real estate and also dramatically bad consequences for real estate. So great time to be having a conversation. Thank you for including me in the panel.
Well, thanks for joining us. We'll kick it off because there's a lot of topics to talk about. And, I sent you guys some overview of what we'll be diving into today. If you have anything you want to share on the screen, please feel free to share your screen whenever you talk about it. And I want this to be more of a discussion. So it's not like we have to hear from everybody on every topic. It's more of just, if this is something that you're more knowledgeable about, you have some input, let's hear what you have to say. But you don't have to participate if you don't have anything to say about it. Just putting it out there. And again, if anybody in the audience has any questions, please feel free to put them in the chat. But let's start with something timely. And tariffs are the topic everybody's talking about every day now. And so I would love to hear your takes on how it's affecting your different asset classes, on whether, I guess I'll start with, well, Neil, you were just up, so I'll pull on you first because you do a lot of multifamily projects. So how do you feel about tariffs, and what do you think the outlook is, in addition to construction cost increases and supplier relationships? What are your long-term views on what's changing for underwriting on these properties?
So in the short term, it's extremely difficult to make predictions, but I've dived into, what really do we buy when we build multifamily or single family? What do we buy from, other places, especially China, right? Given China's at 145% and others are at 10. So it's important to look at that. And then also look at Canada because they have 25% tariffs. And here's the good news. It is common for political commentators to say that the United States has lost its edge as an industrialized economy. The research actually indicates that that is just simply nonsense. You say these things to get more viewers for your TV channel or for your blog. The US is 4% of the world's population, 337 million, less than 4% of the world's 8 billion people, or about 4%. We are 17% of the world's industrial output. We are still, behind China, an industrial giant. We have an incredible, massive industrial system. Now, we used to be 27% of the world's output 2 decades ago, right? So it's gone from 27% of the world's output to 17. Part of that is not because we shrank, it's because other economies, especially Asian tigers, grew. So they became a bigger part of the world's industrial output because they built their own factories over the last 2 decades. So that's the first thing to note, that we are actually an industrial giant. We just don't like to call ourselves that because we're less of a giant than we used to be. The second data point is we actually produce about 70% of the stuff that we use to build single family homes and multifamily in the United States. So 70% of everything that we buy comes from the US. 30% of it comes from outside the US. It's very important. Now, it's that 70% of the US does have some components that are from outside the US. So the overall number may not quite be 70, it might be 60, 65. So the majority of what we build for single family, multifamily, and I'm assuming for other commercial, classes, there's folks here with, with retail, right? Is built in the US. Also, most of our industrial output is actually not running at 100% right now. We're running lower. Why? Because stuff coming in from China and other places is cheaper. And so that means a lot of our factories are not running full tilt. If the tariffs go any higher than 10% for the rest of the world, and they can't possibly go higher for China because now they're a joke, right? At 145%, China can't sell anything to us. Then we will need to ramp up our industrial output. A lot of people keep saying it's going to take 5 years or 10 years to build factory. They're 100% correct. It'll take 15 years actually to build factories. But here's the cool thing. People forget that we already have factories in the US for practically everything that we make that are not running at 100%. When Tesla, was on its ramp and it was getting huge numbers of order for the Model 3, I live in Fremont, California, which is the home of Tesla. So they have a huge factory here, their first factory. When they did that, they didn't build another factory to build their next 500,000 cars. You know what they did? They installed a massive tent in the parking lot of their Fremont factory, right? A massive tent, right? Huge. And then they basically built 500,000 cars inside that tent. That's American ingenuity. We're not going to immediately have people start installing new factories. They're going to basically figure out how to get 50% more output from their factories. So in the next 12 months, all bets are off because it's going to take time even to build tent factories. So for the next 12 months, we are going to see massive inflation. Doors, windows, doorknobs, all of those things we're going to see massive inflation in. And so if you're doing new construction, you better have a huge amount of padding put in because you don't even know how much to pad, right? Normally, right now you have no freaking idea. But beyond the next 12 months, you'd be surprised at how quickly we would pivot because there's two kinds of pivots possible. One is we'll build more stuff in our existing factories. Second, we might build some new factories. I don't think we'll build them in a year. But third, we'll pivot away from China to other partners, right? So regional blocks, our relationship with Mexico will get deeper. So I think all of those things will help. But in the next 12 months, anyone building is very courageous. That's all I'll say.
That's really interesting, especially with the slowdown in new starts. How that'll play out in a few years, we'll see. But I've heard a lot of different rumors about industrial, Andrew. So let's ask. I've heard rumors that there's a lot of industrial sitting empty. Is that true?
Maybe in certain markets where there could be again new supply coming to the market, but for the most part, I mean, take a step back. I think in the long term and the short term, I think we're seeing generally more demand than supply. And again, if you're looking about specific markets, there may be some imbalance, and those are getting absorbed. But to kind of go back to the original question on tariffs, I think we have a roster of 100 plus tenants, many of them manufacturers, factories. So some import, and they may get impacted. Some export, there may be some impact. So then that's definitely top of mind, and we're actively interviewing most of our tenants, kind of what is going on, what's their views, and I think that's sort of the uncertainty right now. Everyone's trying to figure out how tariffs may impact. Well, first of all, how tariffs will shake out. It's still, you asked a week ago and today, the numbers have changed. Things are still shifting around, but so there's definitely uncertainty. And I think because of that is going to be some short-term, kind of pauses. If you're talking about maybe a tenant looking to sign a new lease or renewal, they may pause on that, do a short-term lease. So there's definitely be some short-term impact just because of uncertainty. Everyone trying to figure out, to Neil's point, like what's going to happen in the next 6 to 12 months. There may be specific areas where, if tariff is in for sure, that's going to impact, import export. There may be certain logistics around the port, so will be affected. One thing that we've been definitely keen on looking at is, because we're looking at tenants signing long-term leases, are there any force majeure issues in their contracts that, can come up, especially for businesses that are tied to or heavily rely on exports and imports. So there's, these things kind of to think through, but I do want to say, and the administration have said it, their goal, and tenants, one of the primary reason is to protect and reshore manufacturing capability back to the US. So that's the long-term goal. So in the short term, there's a lot of uncertainty, may get impacted negatively, but in the long run, I think, and not just this administration, right? The previous administration too, the goal is they want to bring more jobs. They want to create more capacity here in the US to produce our own goods so that we're in the better, competitively with the rest of the world. So we're going to do whatever we can to invest and to prop up the industrial and manufacturing capacity in the next 10 years. So that's kind of what we can count on. It doesn't matter which administration. And so, so from a long-term perspective, in spite of what's going on in the next 6 to 12 months, I think industrial in particular is a very strong sector to bet on for those reasons.
Yeah, and it sounds like, well, if we're making all of our own building supplies mostly already, that's not really going to slow down the growth of building new supplies for manufacturing. So maybe there's the ability to boost, but I did hear some rumors over the last several years, and that's why I wanted to address it. I was wondering if there's anybody else, like, is self-storage affected by tariffs at all? Or, I know retail, let's dive into that too. So Scott, go ahead. Is there anything that it would affect it?
Yeah, I mean, there's nothing new, and I guess pointing back to what Alistair and I think Neil talked about, all of us have been through these cycles for a while, and so we kind of know what to expect, and so we're just kind of adding on to our story that we know is going to play out because we've seen this before. So nothing new on this end. We're going to see some increase in costs, and then there's going to be some projects that are going to die on the vine. There's going to be developers that are going to go back to the numbers, be very I would say conservative in what they feel the increase in costs are going to be. And we can look back to see the last time that tariffs were imposed in the storage industry, and it was you could say it was devastating, about a 200% increase in costs that killed a lot of projects midterm. It's one thing when you hit the pause button on a project that hasn't started yet. That's another thing when all of a sudden it goes up in the middle, or and you're in the middle of ordering steel for a project and site work is done. So, we'll see. New facility construction obviously is going to change. People are going to be looking at maintenance and repairs a little bit differently with regards to different projects, but mostly it's going to be there's going to be a restructuring of some of these projects. There's going to be a whole lot of folks that are going to be value engineering the ones that they have if they're too far down the path. And if they go forward, there's going to be, some compressed margins on these projects. There's times where people, developers have got caught out in the middle of a project, and you can't stop. And so you have to kind of go along for the ride and continue to watch your costs as much as possible, and grab more capital if you need to. Fortunately, in storage, we've had we got profit margins of 35 to 45%, which is strong. But we will have to pass that along, just like everybody else in this economy, in the beginning, to see where everything shakes out with we would expect probably a 5 to 10%, depending upon the market, increase in rental rates. As we pass this along, there won't be as many promotional discounts. There will be some competition in the market, as always. But we'll also make that up in fees. We've done that in the past. And so we'll try to get low rates, so similar to what an airline does, and now they're all doing, and charging for everything, not just bags, but we will do the same thing as well, and adding some additional fees in our industry. Reducing staffing, which we've done already from technology, has allowed us to be able to reduce one of our largest expenses, which is payroll. But then on a macro sense, if you're looking at long-term effects, you're going to see smaller operators with less financial flexibility. They're going to have to sell some. Hopefully they could sell at a profit, and they won't have to give these back to the banks before they have to refi. But the larger players, the REITs, regional players, national players, are going to be grabbing up some of these folks, as the smaller players, if they haven't created value, they're going to have to sell. There's going to be a lot of merging. It's been, our industry has seen, the asset classes that's represented by the rest of this call, excluding myself, they're in a somewhat mature industry where 80 to 90% roughly is dominated by the REITs, whereas self-storage is still, we're lagging behind. We're about 20 to 30% is owned by the REITs, and the rest is mom and pop. And so it is the great race to scale up now. For those of us like myself, we're merchant developers, and we also we increase these portfolio sizes to a place where it makes sense for a REIT to be able to sell. And so that's been our model for a while, and a whole lot of entrants into the industry are going to be doing the exact same thing. So I think we're going to see an accelerated pace and a concentration of folks that are looking to roll up. And then with those additional costs, other innovation besides technology that I mentioned, we have been looking at different. With regards to not just steel and aluminum. We use a lot of steel and aluminum. Our buildings are made of just that, all that. We don't have a diverse mix of building materials, but we are looking at different prefabricated construction techniques, as well as different designs, alternative building materials. We've been looking at that for years, and I think we're now going to see some of that coming into play. And from an international standpoint, if we take a look back, the U.S. based REITs, they have to continue to grow to produce returns for their investors, and so they may be looking at entering into other markets without tariffs that don't have the impacts. Foreign investors are going to see, reduce their U.S. storage investments due to compressed margins. So a lot of the money, the capital that has flowed in from other parts of the world into the U.S., that's going to probably be reduced, if not, well, it's going to be dramatically reduced until things shake out, because these markets don't like any type of volatility
Well,
whatsoever. Restructuring. Yep, go ahead, Dina.
You just cut out, so I was just filling in
Oh.
the sentence. Well, sorry, I don't know what you just said at the end there, but I guess you're kind of segueing into our next topic, which is like the recession risk.
Yeah.
I guess real quickly, do you feel like it's going to be something deeper or something mild, or?
Let me get my crystal ball out. This one's going to be a little bit different, as they all are. We see in storage specifically. We're going to see interest rates are going to play a role. We see from an equity standpoint, a lot of our equity players are going to be sitting on the sidelines, so it's a little more difficult for us to be able to get equity to come into our projects, and so that's going to naturally slow things as well. We have no less of an appetite for existing facilities as well as development, if we can control the cost, because we know heading into a recession, self-storage is affected less than most of the other asset classes. As a matter of fact, we do better because there is when there's a consolidation, when there's trauma and transition in the market, we do better.
That's a good point. Heath, do you feel like the tariffs and a recession are a real risk for retail?
Yeah, I mean, look, I think, is it Ryan? I think is going on vacation. Sounds real.
Yeah, I was gonna say, Ryan, I wanted to hear his input soon, actually.
I'd like to take a week off right now. It's definitely an interesting time in retail. So I think it's too soon to tell. Obviously, all of this is rather new. There's a lot of posturing that has turned into actual tariffs, and there's a lot of people brandishing their weapons. I think, as far as retail goes, uncertainty is not great, obviously. I think if you think about it in the near term, all the uncertainty that we're seeing could certainly impact how businesses think about expansion. Certainly, probably is having an adverse impact on consumer spending. I think we all saw the consumer numbers come out today with a pretty low reading. And I think, what I worry about, I worry about stagflation. I think it's a real risk, right? It's harder to manage by the Fed because they can't aggressively push down short-term rates if we're in a stagflationary environment. But definitely with what you're seeing over the last week, right? I mean, you're seeing a lot of concerns around growth, and you're seeing a lot of concerns around rising long-term. I mean, you've seen long-term rates are up, what, 75 bips or something over the last week. I mean, it's been a little bit of a roller coaster. So yeah, there's a lot that we're thinking about that's weighing on us for sure. Now, in the long term, right, well-located retail still has a supply-demand imbalance that's very much in its favor, and that's been a major driver for us over the last several years, right? And what we also saw during, if you look back at previous cycles over decades, what you see even during the Great Recession, stronger retailers that have still, despite all the chaos in the markets, a lot of them are public companies, and they have strong balance sheets, and have a lot of cash, and they're well positioned, and you still see them expand even in sharp downturns, right? Because they still have to grow, but the pace of that just slows. So you could see keep going in a pretty volatile way. You could see a slowdown in expansion. I think as far as what it means for us, as a company if we're in a recessionary environment. I think, you'll see, I don't think I'm saying anything novel here. I think you'll see a lot of investors take more of a risk off position. I think, that could allow for some cap rate expansion. Could certainly provide for opportunistic buying. I think Mike said this at the very outset, or somebody else did. Maybe it was either Mike or somebody else, but I think it was Mike. When you get into these environments where there's a lot of uncertainty and there's blood on the streets, quite often that's the best time to be looking at new opportunities. So I think what you would expect to see if we get into some sort of protracted downturn is the sort of continuation of the theme we've seen over the last couple of years, where the sponsors that really pushed pricing and leverage to levels that were unsustainable. They could basically have to give up. They would experience even more distress than they've already experienced. That would create some pretty interesting buying opportunities. That's not specific to retail. That's specific to, that's across multiple sectors. So anyway, those are my high level thoughts.
Well, thank you. I want to hear from Ryan and Alistair. You guys have a, economic view that would be really interesting to hear. Ryan or Alistair?
I can go first. So there's two broad things that I would say. The first thing I would say is we're at a point in time where a lot of the things that we used to consider to be, I'm going to be a geek for a minute, so I'll apologize, but things we used to consider to be constants in the equation are now variables. And so I emphasize that because and I say this as somebody who just, again, I'm writing the code and building the models and running the numbers. Just in the last 2 weeks, I've had to rerun so many times because, 1 minute the tariffs are here and then they're all the way through the roof and then we're not doing that. And then who knows, this is could be a temporary reprieve. Maybe we are going to slap these punitive tariffs on a bunch of trading partners after this, this stay period expires. And so I think uncertainty is certainly going to prevail for any reasonable time. And so it's going to be very difficult to have confidence in almost anything on that kind of unsure footing. The other thing that I would say about this is, it's been a really long time, really since the 1930s, that we've had what I hate to throw this term around, but I'll say it anyway, anything like a trade war. And it was so bad, and it exacerbated the Great Depression, that we haven't tried it in 100 years. And the fundamental difference between now and about 100 years ago is that international trade is a much bigger part of how economies operate. Both in terms of how integrated we are and then how large it actually is. So the US imports a lot more now than we did in the 1930s. Global supply chains have largely evolved for efficiency, not for resilience, national security purposes, things like that. And so we're a little bit off the radar here in terms of what this might actually do, because we've never tried this in a world where we have increasingly focused on efficiency and optimization and integrating supply chains. I don't, the average person might not even appreciate how much of stuff, and I think somebody said it was maybe Neil before, but how much stuff that actually goes into things that are manufactured in the US. There are a bunch of intermediate goods that come from somewhere else in the world. A piston in a combustion engine goes back and forth across the US Canada border 7 times from the time it's raw aluminum to the time it's actually a piston inside of an engine. So to sit there and say oh, is that an import, or is it just part of something that's built domestically? And so my point is, this is just far more complex than the last time we tried this. It's making the mathematics a lot more complicated, but it's adding to a level of uncertainty. But I see that, like a lot of other people here, I look for the silver lining in this. I actually think real estate is one of the asset classes that will perform relatively well in an environment like this. Now, I wish we weren't doing this. I want to be fully clear about that. But if you actually look at how this could impact a bunch of different industries, consumer discretionary industries like that, you could easily argue that there's going to be more of a direct negative impact on businesses like that than there will be on real estate, especially certain real estate asset classes. So I'm not excited that we're in this environment. But I'm happy that I work in real estate and certainly not other industries in the economy.
Yeah, I felt that especially recently, trying to go shopping for certain things that were, 3 times less expensive last week. And I realized all these smaller businesses are going to be really affected by it. So it is kind of concerning where we're headed, because none of us have seen that. So where do you think interest rates are heading? And like, how soon do you think, maybe these tariffs? I guess my guess is like it's going to be at least 6 months long, because the goal isn't it to make the interest rates go down?
This like
I'll grab that if I
five-dimensional
can.
chess that we're playing. So look, here's what I would say. If the market thinks, if the treasury market thinks that we're going to head into a stagflationary environment, because I don't want to use the word stagflation, I don't want to throw that around too easily, because I think it has a very particular definition in economics. But if we're going to be in a more stagflationary environment, which I think relative to a baseline feels like a very high probability outcome, then the treasury market is going to be concerned, because the central banker's playbook says you fix the inflationary side of that before you fix the stagnation side of it, because the concern is that that could become entrenched once inflation expectations start to change and people start baking that into how they go about living their lives. It can become difficult to dislodge. In fact, the last time we saw a supply shock, it didn't come from tariffs, it came from the energy market in the 1970s. It took Paul Volcker and the Fed 2 recessions to actually start to work that out of the system. And that was about a decade after the initial shock in the early 1970s. And so if the Fed, and I'm using if because I'm not going to, what would Jerome do? I'm not going to put myself in his shoes necessarily, but if the Fed is following, or any other central bank is going to follow the classic central banker's playbook on a stagflationary environment, they would go after the inflation side first, and then go after any kind of stagnation in the economy, which means interest rates could be at an elevated level. And I think the fact that you've seen the long end of the curve move up so much, not just because everyone's looking for liquidity in an uncertain environment, but because I do think there's this recognition that relative to what the world could have been like, it's probably going to be somewhat more stagflationary. And so if anybody was expecting aggressive cutting in the short term, they might find themselves disappointed, because again, that's not how the central banker's playbook works in an environment like this.
Well, I'd like to add that I don't think we should expect any cutting in the midterm either. So before we, started a trade war, I think it was reasonable to expect interest rate cuts in the midterm. Short term, who knows, right? But I think the midterm is now permanently affected. I think it's extremely important to understand that it's very unlikely that everyone will simply step back from this. I think that we did something very fundamental, and that there really is no way back from what we've done at this point in time. There's a certain amount of trust that we built over 80 years, and some of that trust is broken. So fundamentally, I see higher inflation because, I think it was Ryan and a couple other people that basically said we built a system for efficiency. We built the system so that it was a worldwide system. Stuff goes back and forth across borders 7 times. We built it for the lowest possible inflation that we can get. So richer countries for the last 4 decades have had artificially low inflation, and in terms have given up more and more of their industrial bases. So there was a quid pro quo. We will give up more of our industrial base and you will give us very cheap stuff. I do not think that we can go back to that after what has just happened. So long-term expectations of inflation have to increase based on what happened in the last 60 days. And I think that if you look at the long-term bonds, if you see the 10-year, 5 years, it's clearly reflecting that. There's an expectation that, look, we can't go back to where we were 90 days ago. And I think that this means, my belief is, and I'll just share my belief, I think that there's definitely different beliefs here. I think that what we just did permanently damaged cap rates for real estate in the US. We expect those cap rates to now be higher, but it also increased inflation. So I expect rent growth in the next 10 years to be substantially higher than the rent growth for the last 10 years, even though the last 10 years has been pretty awesome rent growth, especially in the multifamily world that I live. But I expect it to be significantly higher in the next 10 years. But where we are going to struggle is cap rates. All of our cap rates for any asset class in America are based on the fundamental assumption of stability of treasury rates And I don't think that stability will hold in the next 10 years. It's almost impossible for that to happen. And therefore, we will have a cap rate reset in all real estate classes, and we'll make it up with rent growth, which we will be able to because inflation expectations are going to move upwards.
Is there anyone who can comment on that?
Yeah, I'd love.
I know it's like I'm throwing a hand grenade. Who wants to pull that thing out?
I'll throw myself on it. Everything Neil is sharing is just gold. I think it's worth pointing out, though, that a core piece of inflation expectations. Inflation is a function of supply and demand. And so we are at some level assuming an extrapolation of ongoing consistent demand in the short term. And the University of Michigan survey, the VIX index, everything's indicating to us that, in fact, the opposite, consumers are pulling back. So
I
in the
agree.
short term,
I agree.
in
I think the short term, we've got severe demand problems. But
so this is
I think my comment was more about what happens in the 2026 time
totally,
frame onwards.
yeah. So I totally agree with that. But just to say, there's likely to be, oddly enough, a reprieve in inflation on it or at least a stability to it. Given that really inflation is a rate of change. That's what it is. When we get the CPI, that's a rate of change measure. It's not an absolute measure. And so we will see adjustments there, so long as consumers do pull back, and they have every reason to right now. Beyond that, when we look at, there's just so much here that's been shared. The core issue, and I appreciate that we're speaking about this from an economic and financial perspective, there's an instinct in the broader populace there to try to make economic and financial justifications using politics. And it's like trying to measure distance with philosophy. It's just pointless. The beauty of this situation is that we can default to economic and financial principles to get a pretty good data-based expectation of where things go. At its core, the idea that the United States is losing its industrial base is to refuse to pay attention to what is really the absolute coup of American capitalism. Over the course of the last 200 years, we have moved from an agrarian-based model where that provided the best margins, the best risk-adjusted return on labor and ownership, to manufacturing. So we're induced to do that because we could get out of the cold and the heat, and we could produce things in a factory. Still tough conditions, but a better margin relative to the price you paid. You got compensated better for the sacrifice you made. Then we evolved into the service industry as the rest of the world took over both agriculture and manufacturing, affording us an entirely different level of privilege with the service business, where we've moved now into cubicles. And the question is, do I know anybody, or do you, who wants to move from a cubicle to a sewing machine? I don't know anybody that wants to do this. This is a huge premium on our lifestyle, and it has afforded us untold wealth and simultaneously pulled the rest of the world out of abject poverty to a different level, even at worst, of poverty. In the most recent iteration since 2000, the force multiplying effect of technology has allowed America a privilege never seen in the history of commerce, which is moving into the idea into the realm of ideas, where we quite literally come up with things. And yes, a lot of it gets stolen. Our IP is leaky, certainly in China, all true, but we're still afforded a level of luxury and privilege that dwarfs any other nation in history. It's worth pointing out that even the poorest Americans today, the greatest risk to their well-being is diabetes, heart disease, and obesity. Meaning that at its core, these are lifestyle choices, which is to say the wealthiest nation on earth is so wealthy that our poorest people's greatest threat to their well-being is that at their essence, they will eat themselves to death. To say that we are not winning is to say that we are paying a price greater than others for a lower reward. And I don't know anybody that's desperate to move to Afghanistan or Vietnam. One more thing, and I'll let it go. When at its core, we're saying that these nations that have tariffs are winning, and we want to win. Yet I don't know anybody that's dying to migrate back to my home country of Zimbabwe. There's nothing about those models that induce us to aspire to create those things. So it comes all the way down to tenants. We have to ask ourselves, what does this look like? Well, I know exactly what it looks like. Two things that tariffs do. The first is they crush a new business starts and innovation. If I use an example of two college kids sitting on the couch, and the one decides to buy a Kia for $10,000 and starts driving Uber. His mate 2 months later looks up and says, hey, he's doing really well. I'm going to do the same thing. But now he goes out and that same Kia costs $23,000. So his car payment is almost triple what his roommate's is, meaning that even if he does get work as an Uber, he's got to work 2.5 times as much just to get what his roommate makes in net income. This stifles innovation, it stifles investment, and most brutally, so new business starts, most brutally, it cancels and collapses the middle class. It's not an accident that all of these countries around the world that have hairy tariffs have, on a relative basis, no middle class. Zimbabwe has no middle class. Egypt has no middle class, et cetera, et cetera. So this is dangerous for us to not include in our models and scenarios because these are our tenants. These are our tenants. My friend Peter Atwater coined the term the K-shaped recovery coming out of COVID. It's a beautiful term capturing essentially the haves have more and the have-nots have less. This really runs the risk of becoming a K-shaped recession, where those that bought the Kia and are driving Uber are fine, those that were planning to or saving to get stifled.
I
Very
know we
good
only
points,
have,
Alistair.
yeah, we only have Ryan's time for about 5 more minutes. So I just wanted to see if there's anything else that Ryan wanted to comment on. I know that we're still stuck on interest rates for the same. This conversation is ongoing, but I wanted to hear from.
So here's Deanna. Here's what I would say, because I think there's a lot of, I think the average person doesn't always appreciate how connected a lot of this stuff is. So let me just try to piece some of this together in terms of how I'm thinking about this. I think it's absolutely right that it's underappreciated that we are still a manufacturing powerhouse in the world. And I agree, we have largely moved on to the services sector and now maybe even just ideas because it's higher value add and it's higher margin and it's a much more profitable thing to do, and it improves your standard of living and your quality of life. But I don't think we should discount the manufacturing prowess in the United States. It's different than it was once upon a time. Now it's very technologically oriented. So it's more capital intensive than labor intensive. But if you look at the data, and you can go look this up if you don't believe me, in the last couple of years, we hit record high levels in terms of put in place construction of manufacturing facilities in the United States. And it's not even close to anything that happened before then. And I'm not taking any latent political position on this. I'm simply saying we can be a manufacturing power in the world, but we need to do it in things that are high value add, that at least maybe are not, within shouting distance of the value add that we do from services, but it's not, to Alistair's point, who wants to go work in a textile factory in the United States? Or Howard Lutnick said it the other day, people are going to go put screws into iPhones or that. No, we should not be doing that, because that is a misallocation of scarce resources. We already have a labor shortage in the United States and the developed world. What we should focus on are the high value add manufacturing things. So we should be trying to do semiconductors and electrical vehicles and battery storage and aircraft engines and even planes themselves, specialty chemicals, the things that are really difficult to manufacture, where you need a level of sophistication in terms of the education of your population and the capital resources that you allocate to that. So this idea that we want to, I don't know what, reclaim, seamstress jobs from somewhere else in the world, which is not exactly what we lost to begin with. It's not fungible. Or that we do want to start, putting screws into iPhones or computers or something like that. That's just so inefficient on so many levels. It will just make us worse off. So I'm not saying we shouldn't be a manufacturing power. I just want us to manufacture the kind of stuff that's really difficult for almost everybody else in the world to manufacture. Because then when we do that, then we can export more to the rest of the world. It makes our trade imbalance less, and we don't have to start a trade war to have better terms of trade, a better balance of payments balance. So I always try to emphasize that to people. The idea that we're going to somehow rebalance trade by reclaiming jobs to make shirts or CD players or something like that, that's just never going to happen. But if we can make these very advanced products that a lot of the rest of the world cannot make, that there is significant demand for, then we can have a better balance of payments, better trade balance. It's just, you have to focus on your comparative advantage, right? Again, I'm a geek. I know this, right? As an economics professor, but focus on the things you do relatively better than everyone else, especially if they're high value add, and then you trade with them for things that they do relatively better, which, you know, I think Alistair made this point, to tend to be lower value add, right? Let the rest of the world be a little more agrarian and a little more lower value add manufacturing, and we can be very sophisticated services sector, information sector, and high value add manufacturing. Those things are not, it's not a zero sum game. And I think sometimes if you're political, you paint the world as a zero sum game, and it is absolutely not a zero sum game, because over the last 40 years of globalization and an integrated global economy, it's not even just in the US where we've pulled people out of abject poverty. We've pulled a whole bunch of people around the world out of abject poverty. We still have issues there. I don't want to discount that or sound flippant about it. But the last thing I'll say about this is, in that system, the United States has benefited more than anybody else. So the fact that we've now decided to break the system where we've been the main beneficiary of it just because of political expediency just economically doesn't make any sense to me.
Wow. Well, that went into a lot of different areas here. And my personal thought is that we're going to manufacture robots to do all of these textile jobs. So I think that's actually really what these manufacturing plants are made for, is making more robots. And they've talked about, you know, creating as many as our population of humans pretty soon here. Thanks for your input, Ryan. It's actually a really good conversation. I'd love to have you on a lunch and learn sometime.
Yeah, absolutely.
But I wanted
I'll
to
stick
go
around as long as I can, but if I drop kind of furtively, I'm not trying to do like the old Irish goodbye sort of thing. Like when I go,
okay.
I'll have to sneak out.
Yeah, if you got to sneak out, it's no problem. I'll email you later. But I wanted to hear from Dave, because Dave does lending and he also owns car wash, you know, robots that are doing the work. So I wanted to hear his perspective on the debt and his strategies going into the 2025-2026 era.
Yeah, sure. Well, first off, I agree with half of you, and I agree to disagree with the other half of you. Now, all kidding aside, a lot of good comments. We share some of the same sentiment. I don't know that I'm an expert in every area. I'm not trying to be, but we believe a lot of the similar things. I guess the big, you know, there's a lot of unknowns right now, and people mention the uncertainty. And when we think of the tariffs, it's hard for us to discern where are they going to land, you know, 90 plus days from now. What extreme, what's that going to shake out to be? And it's like none of us really know that, right? It's like trying to predict the rate cuts from the Fed. Are they going to do 2 cuts? They're going to do, you know, the market would like to see 4 cuts. They may do none, right? We don't know. And I think the good thing for us is we're pretty optimistic about our overall portfolio. And it's because we're not really building in any, especially recent acquisitions for the last actually year or two, have not been based on future rates being reduced, right? Like we're not going into deals like that. So I think that's a big factor. But, you know, back to the tariffs, you know, is it going to create you know, a weakened economy? Most likely, yes, right? Will GDP come down a little? Yes. Will inflation go up? Most likely, right? Will cost of housing go up? Yes. You know, do we expect, you know, lumber costs to go up short term, especially from Canada? But to Neil's point, hey, the US can produce quite a bit of lumber. If they, you know, it won't take that long for us to jump back into it. Now, if you go into autos, it's a different ballgame, right? So that could take significant time. So I think we have to like wait to see where it all lands and which industries are impacted more. You know, we have a CIO who's an economist, and he was showing us a map this past week where it was by county, the expected job loss impact per county, per state, based on the current tariffs. Now that's good, you know, that could change, right? And what we were noticing is most states could, you know, the negative job impact could be 5.5 to 6.5%, depending on which state or which county it was. And we were actually doing an assessment of our portfolio as we're in about 6 or 7 states where our commercial real estate is. And we were looking at that because, you know, we are concerned if our tenants lose their jobs, right? Will they be able to pay rents and things like that? And we're pretty optimistic. We think we're about half of that percentage of potential job loss if those types of tariffs go into effect in those areas. So the trick will be like, where does this land? If rates move, it's usually to our benefit if they come down anyway. That'll just mean we'll get better financing on our NPL book of business if we're going to acquire, or whether we're going to securitize, or whether we're going to use our line. You know, our terms will be better if rates come down at all, no matter how much they come down. And it's similar, you know, Neil's more of an expert on the multifamily side. I guess it'll depend on what cap rates are when you're looking to exit, that kind of thing. In recent times, you know, the room pointed out a couple of things. Like we're just finishing a new construction project, but luckily that project's done, right? We're not overly concerned about costs there. We just did a big build-to-rent deal, but half the project's already built. So it depends where you come in on these deals, right? And where these deals are located and how you position yourself. And we have another phase to build, but we actually cut a deal with the developer where that's his risk. It's not our risk. So a lot of it is how you position yourself into a particular deal in this environment, knowing what you know, right? And not saying we have all the crystal balls and that we can figure everything out. We can't, but you're just trying to limit some of those risks. So it'll be interesting to see employment, how that shakes out from the tariffs, where the rates land, those types of things. Will we end up in, you know, a mild recession? It's kind of early to tell that, but we all know things are going to be changing for sure. Now, in the single family residential space, which is about 2/3 of our portfolio, we feel pretty comfortable, right? Because we don't think, you know, if housing costs of new construction go up, the existing housing stock is liable to go up. Like say, you know, construction costs were to go up, I'm just making up numbers, 10%. Well, regular housing may go up 5%, say. So the likelihood that we'll see a big drop in equity that's back in our portfolio, we're not really anticipating a lot of that. Now on the commercial side, it could be a little different, especially in multi and what's been happening. But we like to also come in and buy distress. So there could be actually some interesting opportunities come along down the pike right now, especially in this environment when you start to shake things up like that. You mentioned the car wash space. That's a little bit different. It's more of a, you know, hamburgers by the valuable corner at McDonald's type of model, where you know, will people still have cars? Probably. Will they still need to get them washed? Most likely. The other thing is you're building them as you go. So we have like certain controls. Even in the build to rent, for example, what I like about that space that's different than multifamily, you know, we just built a new multifamily development actually in Austin that's an affordable housing project, right? The challenge with that was you can't lease anything till it's completely built. Whereas in build to rent, you can lease them as they're being built, which is kind of
That's
cool,
a very
right?
big,
You have
very big deal.
flexibility, you know, you have different levers,
Yeah.
you have different levels of turnover, you have lengths of, you know, what kind of maintenance do you have? Now we're more of a short-term player because of our cost of capital. So we're not an insurance company. We're not pretending to be a pension fund. We're not looking for a long-term hold. So a lot of time it's all depends on how you position yourself into the deal. Are you in the development phase? Are you in the initial phase? You know, are you buying assets at CO? You know, there's different models that make sense for different capital, right? So, but yeah, on the NPL side, the big driver there is unemployment. If unemployment ticks up, non-performing mortgages are more abundant and they get cheaper. If unemployment stays between 4.5, doesn't go up to like 6 or more, it's really not going to dramatically impact us at all. It'll just be business as usual for us, I think. So we're pretty optimistic of our current portfolio. That doesn't mean we're not paying attention, because that's where the opportunities will be coming from. So.
Okay, I want to do something just like a little lightning round, just ask real quick, everybody. What are the KPIs or metrics that you're watching the most right now? I'll go ahead and start, Dave. For in general, just like it doesn't have to be about
KPIs internally in the company.
Well, that's what I was saying in general. I don't know. I mean, as an investor, your perspective, like what are you watching the most to help you identify deals that are worth pursuing?
A lot of it for us is based on our cost of capital, so we're always looking at that. If we don't meet a certain metric on rate of return, we don't even go into the deal. Now that could change because of circumstances, but we like to see a certain level of cushion. We also have a certain level of reserves that we have. So there's a lot of we're looking at multiple KPIs, but a lot is driven. We actually get an allocation thesis from our CIO, who's an economist, and we allocate into different asset classes based on the market and the conditions. So the good news is we typically have places to park money almost in every market, right? So that part's good. So I don't know that, he's watching various KPIs all the time as to where we allocate, if that makes sense. So I don't know that it's any one KPI, but rates will be a significant one for us. Unemployment is our big number on our NPL book of business, because there's four main reasons people default on a mortgage. It's death, divorce, job loss, and medical. And job loss is really the variable that we watch the most. So hopefully that makes sense there.
Yeah. What about you, Ryan? Is there any specific KPIs or metrics that you look out for to identify deals as an investor?
We really like to focus on rent growth. Our empirical research shows that about 70 to 80%, if you can kind of time match it up to the cycle of total return on a property, actually comes from the rent growth, partially because it impacts the cash flows during the holding period, but it does actually have an impact on the residual, the terminal value. So we spend a lot of time. I haven't talked about this yet, but we spend a lot of time, especially with what we're doing with artificial intelligence and machine learning, almost single-mindedly focused on being better than anybody in the world at predicting that rent growth vector, because the more we can get that right, the more it enables us to take a contrarian point of view, right? If we like a market that other people don't like, then we can actually buy an attractive cash flow stream at a much lower price point than we could, versus if it's a market that we like, but everybody and their mother likes it, then we don't want to get into a bidding war down to like the last basis point on a cap rate to try to win a deal, if for a market that we also like, but the entry price point is very different. So I would say we are spending not all of our time, but a lot of our time really trying to get better and better at that. More granular, going from the market level to the sub-market level, more countries around the world, not just focusing on the United States, more property types when we can. I would say a lot of the work that I'm doing right now with our data science team is really getting better and better and better at forecasting that, so that we can be aggressive when we want to be, but also not fall for fool's gold if we also think it's a market that maybe everybody loves, but we're not excited about either.
Well, that's interesting. I want to know where you get your data that's accurate, but I was going to call on Erwin. I haven't heard from Erwin in a while, so I wanted to see what his KPIs and metrics that are identifying deals.
One thing we look at is discount to replacement cost, especially, we've always looked at that. Now with tariffs and the cost to build, we're not taking into account the increased cost, because that would only make some of the stuff a bigger bargain. But we're looking at discount to replacement cost, because that'll tell us whether we're the low cost provider or we can continue to be. We also look for properties. It's also a spread between cap rates and interest rates. We need the positive leverage going in. We'd like to be able to distribute at least 8% current to the tenants in the first year before we move rents or convert older gross or modified leases to net, or before we lease out vacant land or add on to the building. So it's about positive cash flow going in. And we're also doing a lot more research on the tenants themselves, and how sticky are they? What are they doing for business? How tied are they to their workforce or to their suppliers or to their customers? That really tells us where they are. And really today, how affected could they be on tariffs with getting supplies in to do their manufacturing or even assembly? We'd like to see a lot more onshoring, and we should have a lot more manufacturing here, but even things like lumber mills, we haven't built a lumber mill probably in 40 or 50 years. So the fact that we're making all this wood available for cutting, we still need to build lumber mills in order to harvest it and process it. And that's going to take time. So we're looking for businesses that'll always remain competitive. This way we know our buildings will always remain full. I'm not so much, because we look at multi-tenant assets, I'm not that concerned in, a credit as I'd be in a single tenant property, because you have credit by diversity. If I'm buying a flex park and I have 90, 80 tenants or something, like last one we bought had 38 tenants in it, and a lot of them have been there for 10 plus years, they continue to renew, that gives me a pretty good feel of likelihood of them continue to renew. So we're looking really a lot at interest rates, a lot at businesses and sustainability. And it's not just about rent comps and sales comps. It's really about the tenants themselves and their businesses.
What about you, Andrew? You guys do industrial as well. Do you look at the same
Yeah.
metrics? You have a single tenant
That's
industrial
right.
space.
So picking back on what Erwin said, we're very keen on credit. And that's oftentimes the first thing we look at, who the tenant is, how they're doing, what's on their, are they over leveraged, and are they on the path of growth? So those are the things that we focus on first in our acquisitions. I'd say the other thing that we look at is basis. Industrial rent and price per foot continue to go up even through the recent downturn, and that's projected to continue to grow. And so we're buying at a good basis. That's just further, and we're signing oftentimes, 10 to 15, 20, even 25-year leases. So we want to make sure these tenants are going to be there, for 10 to 25 years. They're paying, rent that's gonna, their cost of, it's going to be low and continue to be low. That just means they're going to be there for that lease term. And so those, and we also want to, we're mid to long-term holders. So for us, just we got to be comfortable going in. And I echo what Erwin said about, just the positive leverage, the cash on cash. Those are equally kind of what we're focusing on too.
Well, that's good to know. Mike, what are your KPIs or metrics that you help identify deals that are worth pursuing?
So a lot of brilliance in this panel, and I don't think I'm going to say anything new. I'm going to repeat some of the things. We're also capital partners, so we're not direct operators in a lot of these things, other than being, a lender direct at times. So, like Urban said, I really like the metrics of the positive spread between the cap rate and the cost of debt. A few years ago, it was hard to get. People were overpaying, buying at the very low cap rates, and when their interest rates spiked, that spread turned really negative. Today, you can actually get a pretty healthy positive spread. So what is a healthy positive spread? Well, can you get 150, 200 basis points, maybe even more positive spread between cap rate and a cost of money? On a fixed rate debt, low leverage, if you can do that, you have a ton of downside protection. So just a quick comment, we're looking at a deal with LBX, with Heath in San Diego. And we looked at it, we love the asset. I think that specific example, they're buying at a going-in cap rate 9.4% and a fixed rate debt at 6.5%. That's 2.9% positive spread between the cap rate and a fixed rate, low leverage cost of money. That creates downside protection, that creates predictability. Another interesting comment, and all these things depend on the asset class. Again, Irwin talked about multi-tenant flex type of strategy versus retail has a bunch of high credit quality tenants. So looking at predictability of these leases and what are the rent escalations. So essentially creating a predictable cash flow stream, understanding that I think is very important. Another thing was mentioned multiple times. Multiple folks mentioned this, which is really, really important. When you are investing today, what is the value of the price per pound, per foot, relative to the reconstruction cost? So if you can buy below 50% of reconstruction, especially when the cost to build is growing, that's a downside protection. Of course, you need to discount for the age of the building and what kind of maintenance it needs, but it's a critical KPI to be able to make a decision whether a certain investment is inexpensive or cheap. So these are some examples, and I'm going to turn the floor over to other folks. But it's a mix of metrics. And one more final thought that's crossing my mind all the time is a good old saying, preach a lot of change, but change one thing at a time. Guess what? Trump is preaching a lot of change and trying to change a lot of things at the same time. That's incredibly dangerous. And I think many folks mentioned, Alistair, Ryan, he had to depart. We have been accustomed for 30 years to the current world order. And changing this world order fast is very disruptive and very dangerous. So that's the uncertainty factor, that's the danger factor. And from decision perspective as investors, it is significant opportunity for fresh capital. What it feels to me is Trump has caused a lot of uncertainty. This isn't it. Maybe it's part of the plan. The question I ask myself, what is his plan? Does he even know? And I mean this with all due respect. A lot of smart people in the administration or other folks, but Trump is still Trump. He is dealing with his ego, his pride, and we also have to think when we make investment decisions: is this going to be 4 years like this, or this is just an initial disruption? Maybe he'll calm down a little bit and we'll stabilize. And the opportunity to buy during uncertainty is usually great, and then we might achieve some level of stabilization, even though the long-term trend of interest rate change, a number of other things have changed. Still, the opportunity to find bargains is during the times of volatility and uncertainty. Things seem to stabilize after some amount of time with every administration. So first 100 days, a little bit of that, and we're experiencing this today. My sincere hope that we're going to get some stabilization in the upcoming months, and then the new world order, whatever that is, allow businesses to adjust, and we'll be able to continue investing with confidence. That's my 2 cents.
Well, what are your thoughts, Alistair or Scott or Neil?
I'll give it a shot, only because, Deanna, I appreciate you inviting me on here, because probably the second favorite thing in the world next to spending time with my wife and family is sparring with Mike Zlotnick. It's just, it's a favorite pastime of mine. And with a ton of respect, obviously. You know, we've seen this before out of Trump, and yes, the world is watching, and better than 90% are calling him a buffoon and throwing harpoons. But all you have to do is take a look back. Anybody read The Art of the Deal by Trump, and you see what he did back in the 80s when he was going under, and he had a whole lot to risk. Yeah, what he did at that same time, or at that time, which is what he's doing right now, is he brought all his lenders to the table and said, "Hey, you got more to lose than I do. Yeah, I got some equity, I got some cash into this, but you guys are ready to, lose everything if these properties go back to you, and you don't know what to do with them, but I do. So let's find a solution together that makes sense so that we can all move forward." This is really no different than that. I mean, yes, there's higher stakes and there's more at risk, but our economy is broken, and you could say that the world order, yes, it was operating fine, but really was it? It certainly wasn't for the U.S. I mean, everybody's seen the board, everybody's seen the comparison. And so to say that Trump started a tariff war, anybody can take issue with that. And I'm not standing on one side or another, but boy, you look at the board, is it fair or is it not? Okay, everybody's operating nicely, but man, we've been taking it in the shorts for a long time. So when you look at the disparity, it is egregious as to what the rest of the world has done to us. And so, yeah, our economy is broken, as he mentioned. And so, sometimes a sick person has to go to the hospital, and it really sucks for a little while before it gets better. And I do subscribe to that. And we've already seen this playing out. He's walked these things back for 90 days. He's negotiating, but he did get everybody's attention, didn't he? So before we hold judgment in terms of his legacy and how this is all going to play out, because everybody's a prognosticator and think they got it figured out, look at the changes he's made, and he's not backpedaling. He is not saying, "Oh, we really made a big mistake." No, he is marching down the path with a strategy. And so I think before all of this plays out, I think we should reserve our thoughts as to what this is going to look like. It is going to be a little bit painful for a little while. But at the end of the day, I don't think for 1 minute that we're not going to end up in a better position several years from now. So that wasn't the answer to your question, but the question is, what is the KPIs and what are the metrics? I think challenging times bring about some different positive attributes and habits that we create in our business. I mean, anytime we go through a recession, everybody gets hypersensitive to expenses, and we pound them, we pound them, we pound them, we pound them, and we've been doing that exact same thing. But I think more than that, what we learned through this last one is trying to get anything across the finish line. As Neil can attest to in the development field, time is of the essence. I mean, just speed in every facet of our business right now. And so acquisitions, if we could make sense, if we can create value in those as quickly as possible. Conversions are next. We got a bigger yield that we can create value by buying an industrial shell and then turning it into self-storage and getting it to market faster. Everything is about speed, and everybody in my organization understands that right now. Utilizing AI to short circuit so many of our processes in the past and just absolutely moving at breakneck speed is more valuable to us than negotiating for a lower cost anywhere in the business. And so it's not a KPI, Deanna. It's really just more of a mindset right now that we have to move fast. If we write up a pro forma on a project, then we got to close on it and begin to execute before the world changes. Otherwise, we're scrapping it again, as we've done so many times, or we've seen so many people do so many times in the past 5 to 6 years. So that's my 2 cents.
That's a great point. But I wanted to hear from you, Alistair or Neil.
A lot of remarkable thoughts. I think that I want to emphasize what Scott said. Let's see how this plays out. I do think that some of what has been done cannot be taken back. I do think that we will get some benefits out of this. So here's the good part of this. I think a number of the weaker countries, I don't want to use that word, but I think in some ways it's true, will come to the negotiating table and will end up in a situation where we'll be able to sell more goods to them in the future than we can today. So there's a good side to this, right? I don't think China will buckle. I study China more than any other country. I think that fundamentally it's not a culture that will buckle. It's a culture designed to accept pain. These are the people that welded basically locked people in their homes during COVID and welded the doors. And they kept their country shut for 2 years longer. Their ability to absorb pain is exponentially greater than ours. We can't even absorb 3 days of the stock market going up and down before we make changes. These people would not care if their stock market went up and down for a year. So I think that I don't think things end well with China, but I think one of the positive things to emphasize is that we will get better deals with 50 other countries. And you might say, well, yeah, but we get our stuff from China. Yes, but China is not the only country that makes that stuff, right? So Vietnam makes doors and windows too. And so if you get a great deal with Vietnam or India, I think that we are going to be able to adjust where we get our stuff from. So I think that's the good side of this. And as somebody just pointed out, let's just not look at the bad side of what Trump is doing. I'm not fond of how he's doing it, but I do think that we created a system that incredibly benefited us for the first 5 or 6 decades. In the last 2 decades, it's benefited us less and less. And now finally, we've reached the point where it actually doesn't benefit us at all. And so at this point, it makes sense, since we are the biggest buyer of stuff worldwide, for us to make changes to the system. Hopefully, we don't break it while we make changes. So on the good side, we may see China's dominance in the world go down if we do this right. So I'm hoping Trump knows what he's doing.
We're all hoping. So I kind of want to hear, Alistair, just, are you watching any metrics or KPIs to make investment decisions?
Yeah, there's so much here that we could spend many more hours together, I'm sure, collectively. I think that there's a critical distinction that needs to be made about the style of negotiation. Everything Scott's saying is true. This is Trump's historic narrative. This is his typical style, and it has worked for him because that style works in 2-player games. What it doesn't do, and we know this from game theory, is that it doesn't work when we go to multiplayer games. By separating all nations and allocating disparate tariffs, we've now created multiple different players to the game. John Harsanyi and Reinhard Selten did this work, 1971 paper called 2 is Few and 4 is Many, talking about Cold War dynamics. There was a mistakes equilibrium between the US and USSR, and there was no real likelihood of anyone misinterpreting each other. When you bring in multiple players, we assume, A, that we have so much value that there is no incentive for every other one of these 74 nations that have come back to the Commerce Department to negotiate. are incentivized to negotiate and create deeper alliances between themselves. So this is a very, very complicated outcome. And the more players in the game, the more complexities and likely outcomes. So the default is really, we go back to look at Jean-Jacques Rousseau's 1755 treatise on inequality. In there, he talked about the stag hunt. The stag hunt shows exactly the benefits to a coordinated game. The shift that we've seen here in policy is from a coordinated or assurance game to a competitive game. In a competitive game, somebody has to lose in order for me to win. And what this does is we end up in an equilibrium of 1 and 1 unit. Essentially, it's Richard Russell's old line, in a bear market, everybody loses. The winner is the one who loses the least. And so statistically and mathematically speaking, that's exactly how this goes, based on incentives and constraints. So how does this relate to us? What really matters, and this is my work in my own businesses and with those clients that I guide and support, it's about model fragility. The vast bulk of entrepreneurs today have very fragile half-cycle models. You know, an example might be, if our business model is entirely predicated on ever falling interest rates and consequently ever rising asset prices, we have a half-cycle business model. All that it takes is a dislocation of one of those inputs, say asset prices no longer rising or interest rates actually not falling, for this model to be broken. And we're seeing this across the board in real estate just in the last 3 or 4 years. And so what this brings is what I call model blindness, where people can't see this alternative version because they cannot allow themselves to see a different environment. So my work for the last 18 months has been red teaming business models to try to build out ancillary, parallel, adjacent revenue streams to support cash flow and long-term asset growth. This is important. Even to the point of interest rates, we're so embedded. What happens is long trends create, Epictetus said, full bellies make empty skulls. When we have 42 years of declining interest rates, we are sure that that is essentially our God-given right. That's just a matter of time before rates are lowered. But what the last couple of weeks have shown us is that it doesn't matter what the federal government wants or needs, interest rates are set by the marketplace. If that were true, that the Fed could save us, they would have cut rates and inherently brought down the long end of the bond. It doesn't work like that. So we're already inside of 4 years of rising interest rate environments. Everything from the 2-year that went from 0.1 to 4.9, a 49-fold increase. This is already happening. But there's this aversion to that data and that reality because we're sure that the larger trend is going to continue to overwhelm. And certainly that could be true. It's not the way to bet. But at a minimum, I think it's worthwhile for investors and entrepreneurs to test their models for different inputs. It can yield profound growth and results going forward and preservation of capital.
Thank you for segueing into what I wanted to finally talk about. And it's basically, for the assets that are already on the books, what are your outlook expectations for the valuations in 2025, 2026? And I know you're not really a specific real estate category, Alistair, but what are you bullish on?
Flak jackets and silver bullets.
Me too.
I'm kidding.
Me too. Let's buy them together at wholesale.
Going long degeneracy. No, I think that there will be a number of opportunities that will continue to present themselves. I've been a big fan of T-bills for the longest time, but it's not very exciting. I think that any real estate exposure that I have, I'm paying attention to cap rate pressure relative to the 10-year bond, because of course that's a relative trade. The decision to say, do I want tenants and complexity and all this stuff, or for the click of a mouse, could I? So I'm really paying attention to cap rate flexibility and where it is, which sectors we can actually push those raises back onto our tenants. And it's going to be tricky to do, but I think that's an important, that kind of dynamism of tenant and looking to growth industries, or at least recession resistant, not proof, but recession resistant industries, and where they need to do business.
If someone wanted to get a hold of you, Alistair, how could they do that?
I have a.
Well, he's going to be at the gun shop.
What's that?
Gun
He's going to
range.
be at the gun shop.
That's right, the flak jacket facility. No, I actually have a podcast coming out called The Full Cycle Entrepreneur. It should be out next week. But otherwise, you can find me at The Sovereign Guide. That's my kind of primary hiding place outside of social media.
Thank you. Alistair, it's great to have your input. And, you know I wanted to talk more about trade policy and global strategy, but I feel like we're at a point where nobody really knows. We gotta wait and see. That's the theme I keep hearing, is just wait and see, and kind of hear, or wait to see what happens. And so we'll have you on again in the next, round of panelist discussions or lunch and learns when things progress. So it might be a little while, but thank you.
Well, I'm grateful to be here. Thanks everyone for your help in opening and twisting my own intellectual kaleidoscope. Appreciate you all.
Yeah. We have been talking for an hour and a half now, and so I just want to make sure that I'm being respectful of everybody else's time too. And I wanted to give Andrew an opportunity to say, like, with the assets on the books, what are your expectations for valuations in 2025 and 2026?
I think going back, when we're talking about recession topic, really we've been going through that the past couple of years, from a real estate standpoint, like, the fact that all of us are here, we kind of weather through that significant interest rate hike. I think our values have reset over the past couple of years. And, and so kind of looking forward, the base case is, that interest rate kind of remain where it is. I suppose it can go up. I think the more things will break before it breaks real estate, because we've weathered through a lot of that already. And so so the expectation is that things remain the same, and if rates come down, it will just just means lower cap rate, higher valuation. I'm not counting on that. That's not what we're telling our investors, but that's always a possibility in the next. But we're also looking at 5 to 7 year horizon. The next couple years, probably just kind of remain the same. Will be the kind of the base case.
And that's drastically different, probably, from self-storage. What are your outlooks for the assets already on the book, their valuation? Are they in recovery, or are they, I hear mixed things about self-storage, so I just wanted to get some clarification.
Yeah, we're going through a challenging time right now, still in the middle of or coming out of the midst of the rental rate wars. All these the products, the facilities that came online during a time in which the housing activity level just came to a standstill, and 30 to 35% of all of our rental activity comes from the housing market, from new housing. And so when houses are selling, when people are moving and trading in, trading up, that accounts for an awful lot of our demand. We are in the trauma and transition business. There's a number of reasons why people rent self-storage units, but a lot of that is driven by the residential market. So when we had a standstill there and all these products came online, the REITs and the national players, the only way that they could get occupancy was to buy it. And in order to buy it, it means that they reduce their rates by 50 to 70% in order to steal occupancy from other facilities. Somebody's still going to utilize storage. They'll go down the street if they're saving, 50, 60 bucks a month. They wouldn't do it with a 5 to 10% like we normally would see. And so in order to compete, then the rest of the markets and the players in those markets then had to lower their rates. And so we all know what happens to valuations. If the entire market or the entire industry is down 30 to 40% in terms of rental rates across the board in a high cap rate environment, that spells trouble for all of us. So fortunately, we've been able to hold on to our facilities, and we had one exit just recently in which we didn't come anywhere near our projections because of the market that we're in. We're in a high cap rate environment, and our NOI never met its expectations. We were never able to see the light of day and in terms of writing out our pro forma. So that's fortunately, speaking for myself, we got a number of projects in our funds that we're 2 to 3 years away from exiting anyways. We're building value in those. So I just we are still doing our level best to make sure that we have the ability to raise rates. Rental rates. We certainly are anticipating and hope. Hope is not a strategy, but we all know that we don't know exactly what that's going to look like in 2 to 3 years from now. But we hope that the interest rates and therefore subsequently cap rates are going to be lower, so that we will be able to hit our marks with these projects. So nothing that's causing us an awful lot of constipation right now. But in 2 to 3 years, if the market looks the same as it does today, we won't have met our projections on many of them. But holding steady right now. So long-winded answer to your question, Deanna, is where we sit right now. And thankfully, we don't have any portfolios or syndications or projects that are sitting at a 5-year mark where we have to sell this year.
Well, thank you. How can people find you, Scott?
Best way is by way of either our podcast as well, the Self-Storage Podcast, and then all things self-storage is selfstorageinvesting.com.
Thank you. I forgot to ask Andrew. Andrew G, how can people find you?
Look me up on LinkedIn. If you go to our website, magcp.com, you can reach out there too.
Awesome. Thank you. Who wants to go next to answer?
I'll go next. I need to run off to a bank conversation. So I think I'll end with this. I think that what happened with tariffs is going to potentially lead to a recession, and we may not be able to cut rates. So on the good side, I think that for those of us that have distress funds, we have 100 million in a distress fund, there's actually going to be more distress of new assets, new construction assets that basically just don't value. There's a whole bunch of assets now being built that are just finished or are in lease up, where the total value of that asset that somebody would buy it for is less than the loan amount. And so we are seeing banks like CoreVest, like Benefit Street Partners, these sort of sharky New York equity funds that have more and more assets where the value of the asset is less than the loan amount. And so I think that there's a lot of opportunity there to pick up these assets. You probably won't buy them leased, but you can probably buy them finished with and slightly leased. So I think there's incredible opportunity. For the first time and possibly for the last time in US history, in the last 12 months, the price of a Class A property on a per door basis was $8,000 less than the price of a Class B. I call this multifamily inversion, right? This is not meant to happen. And it's only happening because there's so many assets coming to market and there's such ridiculous concessions that the net rental rates for Class A are lower than Class B. And so I think it represents an incredible opportunity. I think similar opportunities exist in some of the other areas. Self-storage, sounds like might have some of these opportunities there as well. So I think it's a good time to look at the distressed asset, and I think the distress plays out longer.
Thanks, Neil. How can people find you?
Multifamily University. So we do a lot of webinars. We like to share our information in webinars. We're doing one on a 2-parter on artificial intelligence that we expect 4,000 people to sign up for. So multifamilyu.com. It's free. We don't have an educational product.
Awesome. Thank you. Thanks for joining us today. I'm going to go on to Erwin. What are your expectations for valuations in 2025, 2026, and what asset class?
We focus on multi-tenant industrial and shallow bay flex, and it's an interesting time in the market because on one hand, we're seeing some great valuations that are enabling us to refinance and cash out on assets we bought 3 years ago at significantly lower rates for more dollars. And on the other hand, we're seeing some significant opportunities to acquire on higher cap rates. People are bleeding on other assets and need a quick execution, or baby boomers, as a family-owned asset, and they thought the kids would take it over and continue to own it, and they don't want it; they want the cash. And we look at smaller assets where I'm not really competing with BREIT or Starwood or others. So in the size that we look at, I'm finding there's less of a buyer pool. So there are a lot of interesting opportunities to buy, really, pound per dollar with positive leverage and cash flow. A lot of stuff at 8.5 to 10 cap. Going in on leverage on existing cash flow. So we're seeing a lot of interesting opportunities. Some of our assets, we've had some interesting offers to sell them at a profit, but because we have very low fixed rate debt or capped floating rate debt, and we're in the money on the cap, and we don't see the urgency to sell them if we can continue to ride out any uncertainty in the market and really make sure there's a proper exit. We always take longer term debt than we assume the hold is going to be, because this way you can always focus on the real estate and not have to worry about a capital markets event. So I think we're very fortunate upon that. I think that the next 24 months is going to be a great opportunity to buy if you have cash, or you can find the cash to buy. And you might pay a little more in interest rates, although we just rate locked a 67% loan with a life insurance company at 575. So there are a lot of interesting opportunities out there. It's also a question of the lender. Are you going life company? Are you going banks, which are not in the market? Or are you going to deal with the sharks on Wall Street and the CMBS shops who really don't have the money and need to find it for you, and you're really at the mercy of the B-piece buyer. So I think that there's going to be a lot of good buying opportunities in our asset class, and we continue to find them.
Thanks, Erwin. How can people get a hold of you?
Well, you can go to our website. It's heritagecapitalgroup.net, or you can put my name into the search bar, Google, you'll find me. I speak at a lot of industry events, or you can find me on LinkedIn at Erwin Boris.
Boris is very similar to boring, but we're not related. So Dave was going to call on you next. What are your expectations? I know you're across multiple different asset classes, but I guess give us a quick overview for each one, your expectations for 2025, 2026.
Yeah, I mean, we're pretty optimistic. I mean, on the NPL book of business, which is non-performing loans, they're residential. We believe the equity is going to stay there. We don't feel it's going to be dropping or anything. And we're already forecasting some significant acquisitions coming down the pike. So we're pretty confident in that area. As far as the commercial real estate we have, we bought some things at different cycles, different timing of the cycles, but for the most part, we have mostly fixed rate debt, mostly long term. Some we assumed, some were we're about to exit in the next year or so. It depends on what rates do. If rates come down, that's favorable for us. We have a lot of flexibility, though. That's what's good about our fund. So pretty confident in that area. But I'm in Erwin's camp. We have a lot of opportunity in the commercial side, and we're just seeing it day after day right now. We're seeing a lot of opportunities already. So we probably have more deal flow than capital at this stage. So for us, it's pretty optimistic. It'll be interesting to see what happens with, like you said, the tariffs and the rates. And we didn't even touch on debt, like the U.S. debt to GDP and where that's going to land. It'll be, they're talking about, extending these tax cuts from Trump. It'll be interesting to see where that lands, 3, 4, 5 years from now, because that's about a 4 trillion, right? And with all the cuts and, what kind of revenue are they really going to get from the tariffs? Are they going to get, 1.5, 2 trillion? That debt will probably continue to grow. And, we're probably at 100% now, debt to GDP. So what's that going to look like 3, 4 years from now? So that part is probably the one area that is in the back of my mind a little bit. What impact is that going to have on us in not too distant future, right? But a lot will depend on like everybody was talking about today. Where do these tariffs land? How does it shake out with the increase in costs? Will the rates come down or not? Most likely they probably will be some type of reduction. The question will be how much and when. Hopefully that still comes. It might not be what the market would like to see. It'll probably be more like what the Fed's willing to do, and they don't have a lot of tools based with all the craziness going on, whether with unemployment, inflation, and all these other things going on. It's a lot of variables that they're trying to solve for, and it's almost an impossible problem to solve with the tools that they have, kind of thing. So it'll be interesting to see that. But I think we're positioned either way. We're fortunate we're in these alternative investment asset classes. We're not in traditional markets, right, for the most part. Sure, we're impacted, like everybody's going to be impacted by interest rates, for example, and things like that. And tariffs kind of impact the cost of consumer goods and things like that. But it'll really shake out, like Neil was saying, what is it exactly? Which countries is it? Who's impacted the most? It'll be interesting to see. Now that will dictate where we will go. So it's hard for me to say, yo, I don't have the crystal ball on the tariffs. I don't have the crystal ball on the rates, but I'm going to have a crystal ball on what I'm going to buy when. And I really don't have that. It's kind of based on all of that together is typically how our company would roll with that. So hopefully that makes sense.
Yeah, it does. I want to like take you up on maybe doing a lunch and learn together about the GDP and diving more into the debt conversation. But how can people find you, Dave?
Probably easiest as well on LinkedIn, or you can go to our website, pprcapitalmgmt.com, and find out more about us. Yeah.
Thank you. I saved Heath for next. Mike will be last, but Heath, I wanted to ask you, what are your expectations for 2025, 2026, valuation wise? I know it's kind of an anomaly in your case. You're muted, by the way.
Thanks. Yeah, I mean, look, like we tend to buy a little bit wider than, you know, multifamily, right? I mean, retail's been that sort of space for a long time, but, you know, it's hard to know exactly where valuations are going to go. Obviously, it's hard to know what's going to happen with interest rates. You know, I think that as a company, you know, our track record is one where historically, you know, we bought assets at, you know, very attractive price points, and we care a lot about flexibility. So we, you know, we don't use floating rate debt. We've always fixed our debt. We, you know, we are, you know, pretty low leverage guys, and so it gives us a lot of flexibility, which is really good. And you know, the other comment I'd make is when, you know, from a capital stack standpoint, you know, we have lots of institutional relationships. However, you know, since we go deal by deal, we don't offer a fund. Since we go deal by deal, what you know, we've historically done is we've syndicated, and you know, a big benefit to that is we don't have a, you know, quite often we don't have an institution with, you know, some sort of unfavorable control provisions telling us, you know, look, we've got to, you know, we've got to exit that asset and bring it to market at a time when it might not be ideal to do so. Now we love to take advantage of those situations as buying opportunities. We've done that quite a lot. You know, we love deals that are, you know, end of fund life. They can create some of your best opportunities. But you know, in terms of our existing portfolio, the main point is that we have a lot of flexibility embedded in what we do, and that's, you know, really good spot to be in. And now when you know, kind of you know, dig in and look at the, you know, look at the assets. You know, Mike made a comment earlier about you know, about positive leverage and you know, how it's something that he likes about, you know, there's a new deal that we're doing, but also just about retail in general. And it's true. You know, we've, you know, really good positive leverage in our assets. And what's interesting about it, you know, about that characteristic is we'll start quite often with positive leverage, and then, you know, as we make accretive decisions, we improve our yield on cost as we go. So, you know, kind of going back to the metrics discussion, that's definitely something that we pay a lot of attention to. And, you know, if you look across our portfolio, there are certain kind of key characteristics, even though we own property all over the place, there's certain key characteristics that, you know, kind of run through our portfolio. You know, we emphasize buying, you know, really well located centers with strong demographics, you know, a lot of nice attributes like great visibility, ingress, egress, good access, right? You know, good tenancy, you know, boxes that, you know, fit the modern day needs of tenants, you know, good sales metrics for tenants, low crime, adequate parking, great credit with our retailers. And I can go down this, I can go down the list. There's a lot more than that, but
Right.
we have a portfolio that's, really functioning very, very well with a very healthy spread between our, where our yield on cost is and where our financing cost is. So, at the end of the day, we'll be very well positioned we think, to take advantage of whatever the environment looks like in, 12 to 24 months. We don't have a, metaphorical gun to our head, telling us that we've got to trade into a market if it's not favorable.
I like that confidence, especially, there's probably a lot of question around your asset class right now with all the headwinds from, politics and interest rates and all the things that might affect the future. But I think another key component there is the amount of supply there actually is available. And what we saw with COVID, it's interesting how tenants have changed to be more long-term, stable, you know, ideal partners to go through any of the economic ups and downs. Usually it's, some kind of service-based industry. So Heath, how can people find you?
I'm easy to find. You can just email me at Heath, so HEATH at lbxinvestments.com.
Thank you. Mike, I saved you for last so that you could tell the audience, are there any key KPIs or metrics that you're looking out for in order to spot a deal? We talked about that last, but we also went into what your expectations are for valuations and recovery for 2025, 2026.
Thank you, Diana. Yeah, a lot of great wisdom here. So I'll say the obvious things, right? Great time to be a buyer, not necessarily the best time to be a seller. Most of the stuff we see today, if you need to sell, a lot of vulture buyers circling around, including all of us, looking for great deals, right? So every difficulty creates an opportunity, and it's a difficulty to be a net seller in this environment. So 25 is expected to be still a difficult year with all the uncertainty, potential recession, interest rates being high, all the headwinds. But on the opportunity side, it's a great time to buy. So a lot of the stuff is it's a precision. It's like a surgery. You're really not looking to buy a lot. You're looking to buy really good stuff. So on the acquisition front, I think we continue to focus on working with some of the best partners. Again, some of the folks on these panels. We work with many of you, right? So we love your strategies, and we love sort of not deal volume, but precision, a few great deals. So on the acquisition front, again, we will continue to do exactly that, and many of you continue to focus on just finding gems, motivated, tired, distressed sellers that have to transact, and that creates opportunity for the buyers. Now, on the existing portfolio side, let's not put lipstick on a pig. I'm just being as open and transparent. Some of these assets that were acquired a few years ago at the peak of the market, when the interest rates were low and the market has been destabilized, completely changed. As Neil said, many of these ground-up construction projects, the completed value is less than the debt. So the market reset significantly. What the size of reset? It depends on, obviously, the asset class, location, specific conditions of the property. Well, we've seen anywhere from 20 to 40% reset. I may be off. I mean, in some instances could be less. But if you look at this 20 to 40% reset means what? If you are an equity player and if you're forced to sell, you lose most, if not all, equity. So now is not the time to sell if you can hold on. There used to be an expression, survive until 25. Now it's survive until 26, right? So for those who can find ability to survive, bring in additional capital in the form of mezz debt, fresh pref equity, capital calls, whatever you want to call it, but capital can be raised, and the assets still fundamentally solid long-term basis and they can survive, then there's chances of better exits in 26 and beyond. Now, I'll just add a couple more comments. It almost doesn't matter where the interest rates will go. It matters, but if you think about it this way, Neil mentioned this, and I'm going to cover a couple of points here. One point is if interest rates stay high, maybe even go a little higher due to the inflation. Usually interest rates are high because inflation is high. It can't be any other way, right? The interest rates reflect the state of inflation expectations. So if inflation is high and sticky, it means rent growth is good, right? That's the general theory behind it. So again, back to Neil, if rent growth for the next 10 years is healthier than the last 10 years, even the interest rates stay high, we outgrow through the NOI growth versus the cost of capital, i.e. interest rates. On the other side, if somehow we see slowing economy to the point where unemployment picks up and inflation is not as bad, maybe the tariffs come off the table, maybe there's some stabilization happens, and the interest rates cool, then we get a little bit of tailwind on that front too. So what I would say is this. Exiting deals in 25 is just not good. It's exceptional situations where these deals would be good for existing investors. 26 and beyond is where probably the best optimization of value, if you can manage it that far. Many of us buy with fixed rate debt, but some of these deals have term maturity. So the bottom line is real estate, the entire industry needs somewhat low interest rates, but it may not happen. So the refi will continue to be a challenge if interest rates can stay at the elevated level. But if the rent growth is healthy enough to support higher NOI, then we can tolerate high interest rates. So the wisdom here is that we will have to be dynamic and opportunistic on a buy side and as patient as we can on the owner seller side and wait until better times and bring these assets to the market when the market seems to be flush with liquidity, even if the interest rates don't necessarily retreat. So the market just needs time to stabilize. We all need time to execute better. And the final element is a quality of execution, right? We've talked about this in the past. We've seen this. There are different flavors. There's the operators who do really phenomenal work. Some of you guys we work with, LBX guys or Heritage. This is an example. Or MAG, right? Industrial. You guys execute really well. And makes a big difference. If you execute really well, you get high quality tenants, you're able to work with predictable rent increases and protect downside over time, it works. Even in storage, Scott, right? Market conditions are rough right now, but you know how to operate it. You've been in the business for long enough. With a little bit of tailwind, you can actually stabilize and shape it up. But unfortunately, one of the key messages for folks that tune in, checks written 21 and 22 and 2020, depending on when and type of deal, they're sitting on thin ice. And if anybody's telling you any other story, they're misrepresenting the truth. Some of these deals, unfortunately, have challenges linked to the market conditions. If they can survive and you can tolerate a little bit of the warm period of time and then the ice holds, then you'll have hopefully better outcomes in the next few years. Sort of these are my two cents. And I don't know if there are any more folks. Diana, take us home, wrap it up. Any more questions? I think we are at the end of the session. So I'm not sure if Diana's lost connection, but I will keep it simple. It looks like we're done. We're 2:02 Eastern time. I wanted to take this opportunity to thank everyone for your great participation, your great wisdom, sharing, and we will have commentary and comments about how to reach all the panelists through the notes on when it gets published. So I'm grateful for the panelists, grateful to the folks who tuned in. Hope you all have a wonderful spring and a wonderful weekend. And yeah, enjoy the warmer weather.